Hello, this is Will Allen with Centera Capital. In today's market update, we are going to take a look at the housing market, and we're also going to look at the state of play financially now that the Fed is done with their rate hike cycle, including a stat that I promise you have not heard anywhere else. Let's get into it. All right, now before I get into the market update, just a reminder to like and subscribe or share with any friends or family who you think are not getting these kind of updates. So today, in a few minutes, I'm going to get into the housing market, but before I do that, I'm going to start with taking a look at the state of play now that the Fed has finished their rate hike cycle. It's been about 9 months since their last interest rate hike, and a lot of economists were forecasting a recession as a result of taking interest rates from near zero on their overnight interest rate to 5.5%. That has not happened, and we want to look at some of the reasons why in just a second. Now, currently, the market is pricing in that the Fed is going to be cutting interest rates between 1 and 2 times in 2024. And if you look at this chart, this goes back to the start of the year, and you will see that the market was pricing in almost 7 rate hikes in January. We thought that was a little excessive, and that was not likely to happen. Over the last 4 or 5 months, that has come down, and we are now at around 1.5 rate hikes for the year. Now that means rates are staying higher for longer, and that does have an impact on the consumer and on businesses, but not as big as what a lot of economists thought, and we know some of the reasons why. The first reason is that consumers paid off a lot of debt when COVID happened and there was a lot of stimulus. We're going to take a look at a chart that goes back now to the 1980s, and it's taking a look at what percent of consumers' after-tax income is going to service debt. So credit cards, auto loans, mortgages. And when you look at that chart, you will notice that today, about 9.8% of income is going to service debt. That is about the same level that was taking place pre-COVID, but notice it's much less than the average over the last 40 years. And that's important because that means that higher rates on credit cards are not hurting the consumers as much because they have a lot more of their income after tax than they did for most of the last 50, 60 years. And that is having an impact that is benefiting consumers, and one of the reasons they've remained stronger for longer. Now, here is the stat that I promise you have not seen anywhere else. And we're going to look at the bottom 50% on the wealth quartile. We're looking at the bottom 2, and we're looking at how much money they have in checking and savings accounts. Because when we talk about the strength of the consumer, sometimes people will say, well, hey, is it just the people at the top who are doing well? And this chart that I'm about to show you says that that is not the case. And we're going to throw it up. This is the amount in checking and savings accounts for the bottom 50% in the wealth percentile group. And you will notice that they had a significant increase in their checking and savings accounts once COVID hit. A lot of stimulus money came around, but a lot of increase in wages took place. And you can see that they still have near their all-time record there in their checking and savings accounts. That is pretty impressive, and that will help them continue to be able to spend. Now, let's also look at the growth in their net worth and compare those folks to everyone else on the wealth spectrum. We have a chart for that, and you will notice here on the far left, the top 1%, they have had their wealth grow by 47%. In the middle there, those from 90 to 99% have had their wealth grow 24%. And this, by the way, is from 2020 to 2023. But on the far right percent, the bottom 50%, an 87% growth in their net worth. And you saw that in the first chart I showed you, an amount in checking and savings accounts. That has gone up significantly. So again, this is a positive. Now, one thing I want to tell you, these folks have had a nice increase in their net worth, but we do know that the significant inflation that has taken place over the last 4 or 5 years has put a dent in how far this increase in net worth will carry people. And that's everyone. And that, by the way, is something we've talked about over the last year or so, why consumer sentiment has not done all that well, even though the stock market's doing well. It's an amazing jobs market. But the fact is, higher prices have really been weighing on consumer sentiment. And we just want to illustrate here or mention that even though net worth has gone up a lot, we do know that higher prices have hurt everyone across income spectrums. Now on to housing. Now we're looking at the housing market because it is a very important sector for the U.S. economy. And we're going to start off by looking at the fact that home prices last month in the Case-Shiller National Home Price Index grew at 6.5% year over year. Now, if you look at the history of this chart, you will notice that, and I have on the far right, it says 4.5% average growth in home prices going back to the 1980s, prior to the big jump when COVID hit. And you can see on the far right, home prices grew at 21% year over year early in COVID. In fact, for a 4-year period from 2020 to 2024, home prices are up about 40%, okay? Before that, home prices over the previous 30, 40 years had grown at about a 3% year over year clip. Well, what I want to point out now is home prices are up 6.5% year over year. That's up from 6 months ago when home prices were flat year over year. So they're going back up. A big reason why is there's just very little inventory. Many homeowners have mortgages at 3 or 4%, so they're just not willing to put their house on the market and move and take on a mortgage rate at 7%. So that means not many homes are out there, so people are having to pay up to buy a house. Now, when we take a look at that, we also have to look at, well, what's going on the side of renting? Because you can't look at home prices just in a vacuum. A lot of people, when they're trying to comparison and decide, do I want to buy a house or rent, they compare the two. And when we take a look at what's been happening with rents, notice that those have not been going up at a clip like home prices have. They have gone up. In fact, the most recent month, rents were at about $1,400 a month. They've been in a range there now for the last about 3 years. Notice, though, they are a lot more expensive rents than they were 4 or 5 years ago. And again, when we talk about why consumer sentiment is down versus where it was in 2019, big reason why is because everything is a lot more expensive. But the fact that rents have gone sideways over the last 3 years compared to home prices have just hit new highs, mortgage rates are above 7%, that means if someone wants to go out and buy a house, they're paying a lot and their mortgage is a lot. When we do a comparison of the two, this is going to be a surprise. So let's put up a comparison that takes a look at the premium discount to buy a home versus renting it, and this is going back to the 1990s. Now, what you will notice there is that this has skyrocketed over the last year here to an all-time high, meaning if someone is trying to decide, do I buy a house or do I rent, and they're not sure, right now it's never been more expensive to buy with the current mortgage rates versus rent. And so that's just an important fact for someone to realize because they can't stay at this kind of level very long. This eventually is going to have to kind of come back down. Now, one other thing I want to say about why rents have kind of gone sideways over the last 3 years, a big part of that is because there has been a major surge over the last couple of years in multifamily building, meaning construction of multifamily homes has gone up significantly. That's meant more supply to meet the demand there, and that has helped keep prices lower. Okay, so to recap, we talked about the fact that it's been over 9 months since the Fed's last rate hike. And when we take a look, the consumer has held up much better than a lot of economists thought. A large part of that was due to the fact that consumers paid off a lot of debt early in the COVID days, and so the amount of their budget that is going to debt service is a lot lower than it has been historically. We also looked at the surprising stat that the bottom 50% have seen their net worth increase by the largest percentage of any of the group in the percentile. And so that is important to note, that the consumer could continue to spend in that bottom 50% group. On the housing side, we looked at the fact that home mortgage rates have gone up a lot, home prices have gone up a lot, and that has meant that to buy a house now versus renting it is the most expensive that it's been in its history, and at some point that has got to course correct. Well, thanks a lot for watching and take care. Okay, so if you made it this far, congratulations. I appreciate you watching the whole video. Listen, if this is the first time you've seen one of our videos, you can go to centeracapital.com, look around the site. You can go to the contact page if you want to have a discussion. We have a 3-meeting process up front to see if it's a good fit on both sides. And if you're not getting these kind of updates from your advisor, go check us out. Thank you very much.